welcome to everyone listening in, and thank you for joining me today to talk about employee benefit plans, employee benefit and audits, and to discuss some common errors that we often see through our audits of employee benefit plans, and hopefully to provide you with some ideas around how to avoid these errors. My name is Maria Schwingler, and I am an audit partner in our Eide Bailey, Minneapolis office, and I focus a large portion of my time within our ERISA industry practice and serve as an audit partner on many employee benefit plan audits annually. I specifically specialize in audits of defined contribution, defined benefit, and also work on a number of single employer health and welfare plans. I also serve on our firm's ERISA Technical Issues Committee and have been a part of numerous peer review engagements where I'm focusing my review on audits of employee benefit plans, and also regularly attend the National AICPA Employee Benefit Plan Conference. For those of you that may be less familiar with Eide Bailey's experience in auditing employee benefit plans, Eide Bailey has experience working with a variety of plans, including 401k, 403b, defined benefit, ESOPs, profit sharing plans, and health and welfare plans. Our experience encompasses large and small plans with participant counts ranging from those that meet the minimum audit requirement to those that exceed 40,000 participants. We are also a member of the AICPA Audit Quality Center for Benefit Plans, and this membership is just one component of our commitment to providing quality services to employee benefit plans. The main objectives I hope to cover today is to help provide an understanding of why plan audits are important and how they can help management teams. And I understand there might be a lot of individuals listening who already have audited employee benefit plans, but there may be others that have a plan that currently is not audited but may hit the audit requirements soon. So I'll touch on different types of audits and then help to understand when an audit may be required and what you can expect. The majority of the time, I'll be talking about common plan errors that we've seen over the years through various financial statement audits we've performed and through conversations we've had with our clients who also may have gone through DOL or IRS exams for their plan. You might hear the word audit and it makes you cringe a little bit, but it's important to understand why there is a need for audits in the world of employee benefit plans. According to a 2019 market study that was performed by the Investment Company Institute, there are over 580,000 401k plans in the United States, and that's just 401k plans. These plans have over 58 million active participants, and according to this study, the average 401k account balance in 2019 was over $90,000, and over 6.2 trillion in assets are held within these 401k plans. In 2019, there was over 27 trillion in total retirement assets once you add in defined benefit, other defined contribution plans, IRAs, and annuities. But today our discussion for common plan errors will primarily be around defined contribution or 401k audits. Specifically talking about financial statement audits, which are the types of audits our firm and other public accounting firms would be conducting. They are seen as an accountability mechanism by the AICPA. These audits are performed by an independent third party. Therefore, the external auditor that's engaged to perform your required financial statement audit would have to adhere to all relevant independence requirements for audit purposes. Financial statement audits help to ensure that plans are being operated in accordance with their most current plan documents and maintaining compliance with all regulatory standards. An audited plan is required to produce prepared financial statements and attach those to the Form 5500 that's filed with the IRS. We also feel there's benefit to management when audits are required, especially in a first-year plan audit. There is opportunity to help streamline plan operations, and the auditor can and really should provide information on best practices within the industry. If there are gaps or holes in internal control, audits can help to identify areas for internal control improvement, and also identify areas where the plan or the plan sponsor might be at risk. Specifically, if a plan is subject to an IRS or DOL exam, They may tend to have less flexibility when it comes to certain areas, and you might find yourself in a situation where something wasn't documented appropriately, which might result in a lack of compliance with following your plan document. So with no documentation, it's assumed that it didn't happen. So throughout this presentation, documentation will be a common theme that I point to, but we'll talk a little bit more about some specific examples of when we've seen issues like this. When we talk about different types of audits, the audit that I'm going to be referring to most often during this session is the required financial statement audit needed to be attached to that Form 5500 filing. And this is required for large plans, which I'll cover here in a bit. This audit requires the plan sponsor to hire an independent auditor, as I previously mentioned. And there are two common types of financial statement audits: full scope and limited scope audits. In a limited scope audit, the auditor is able to obtain a certification letter from a qualified institution, typically referred to as the trustee or the custodian. This is the entity that holds the investments and executes any investment-related transactions. There is a Department of Labor regulation under ERISA that allows the limited scope audit, which essentially means the auditor does not perform any auditing procedures over the investments or investment activity. And because these procedures are not performed, ultimately a disclaimer is issued in the auditor's report, but this is a disclaimer of opinion that's considered acceptable by the Department of Labor. The other option is a full scope audit, which essentially happens in the circumstance you do not have a certification. Therefore, the investments are subject to auditing procedures. In the defined contribution world in particular, so most 401ks, 403bs, the large majority of these audits are limited scope audits where a certification can be obtained. The full scope audits that we do as a firm predominantly occur if we have employee stock ownership plans or ESOPs, plans with hard to value investments, and 11K audits or plans that are registered with the SEC. The terminology behind these limited scope audits will be changing here in a few years. So that terminology, limited scope, will go away and now will be referred to as ERISA Section 103A3C audits, based on a new auditing standard that was approved in late 2018. This standard came about in large part due to some not so great results that came out of the DOL audit quality study that occurred back in 2014. So these audit reports will no longer have a disclaimer. Under the new standard, the auditor isn't considered to be disclaiming an opinion, but is instead opining on the non-certified audit areas and performing limited procedures on the investments. High level, the standard change really shouldn't have a significant impact on the plan audit itself or for the plan sponsor specifically, but there will be some additional procedures that auditors will need to perform over the certified investment activity and an evaluation of management's assessment that the entity that's issuing the certification is qualified. Other audits that you might find your plan being subjected to is an IRS audit or a DOL inspection. Both of these agencies, they might perform a random desk audit, or it can be a more in-depth examination. Currently, both agencies have limited resources and are trying to utilize more data mining tactics from 5,500 filings to identify those plans that might get pinged for an audit. I do want to emphasize, though, again, that our conversation today is focusing on external financial statement audits, but much of what we look for in these audits are also a focus of DOL and IRS exam and inspections as well. When talking about the annual audit and understanding when it's required, it's important to know what triggers a financial statement audit under ERISA. We get this question pretty often, and the reality is it's not always straightforward. This chart helps to walk through whether or not your plan is considered a small plan or a large plan resulting in the need for an audit. The audit trigger itself is based off of the beginning of year participant count numbers, with 120 participants being the magic number for the most part. So as an example, if you filed your December 31st, 2018 5,500 in October of 2019 last year, and your ending participant count was 122, That means that your beginning of year count for 2019 was 122. Therefore, you would need an audit for 2019. There's more of a gray area involved in the circumstance where you may be in a large plan situation this year, but maybe dropping down to a small plan. And there is a window between 100 and 120 participants where you must fall below that 100 participant count threshold before you move back into that small plan category. Oftentimes we get contacted late in the year from plan sponsors who need an audit for the first time, but either forget or don't realize it until they get around to filing their 5,500 in the following year. So your third-party administrator or your TPA should be helping you monitor this and making you aware of when the requirement might kick in. But if you think your plan might be teetering around that 120 mark, it's important to be proactive and seek out a quality auditor timely to ensure you don't run into any issues with any potential late filing penalties. This is just an example of the 5,500, and on page 2, that's where that participant count information is included on the form. This number here on line 5 is the count number that I'm referring to. And we also get asked the question often of what defines a participant for this number and who gets included in that beginning of your count number. And it is everyone that is eligible to participate in the plan. So you might have only 75 participants actually contributing in the plan, but if you have 125 eligible participants, you would still need an audit because of the number of eligible participants exceeding that 120 number. And then if you're entering an audit for the first time, what to expect. You know, a benefit plan audit functions a little differently than your typical financial statement audit because of the involvement of a third-party administrator, a TPA. For some plans, there are other parties involved, whether it's an actuary or you might have a trustee or custodian and a TPA. And this creates a unique aspect to plan audits. And in some cases, it may mean that there's less information that the plan sponsor may need to provide because so much of the information is retained by the third-party administrator. But it also can sometimes cause delays in the plan audit process. So in our benefit plan audits, we like to start with an initial planning call that helps us understand major plan events, like amendments to the plan, employer match calculation changes, if there's been any mergers or partial plan terminations. This all impacts how we might approach the testing for the current year. We also like to have a detailed conversation on understanding the involvement of that third-party administrator. You know, will we be working directly with them? Would you prefer us to ask all questions through you and then forward questions onto the TPA from there? It's really good to understand this as much as possible up front. And we're oftentimes given auditor access to the online portal for the TPA, which can really help cut out a lot of the requests that we might otherwise need to ask of you. But from there, you know, we have our audit requests that we provide to clients, and usually those come in 2 phases, kind of an initial request and then a more detailed request at the participant level. And then move through our testing, review, and wrap up with the ultimate goal to get you an issued financial statement that can be attached to your Form 5500. And we know that there likely are some common stressors for plan sponsors when it comes to audits, such as feeling unprepared or feeling like the audit's taking up too much time. But the reality is the more time that we can put into preparing for the audit up front significantly cuts back on that time needed on the back end. You know, we oftentimes will be given information based on our requests, but if it's incomplete, that's ultimately going to lead to additional follow-up, additional questions, and likely additional requests after that. So it's important to read through the requests in detail, ensure you understand, ask questions, you know, understand what we're asking for, why we're asking for it, and ultimately should help reduce that time on the back end. And then staying organized throughout the year and retaining appropriate documentation related to any plan changes will help when any questions might come up during an audit related to those changes. So if you have a plan amendment happen during the year, make sure you understand the impact that that amendment has on your plan in the administration of the plan, whether it's payroll related or documentation retention related. Responding timely to requests is also key to ensuring efficient audit process from beginning to end, again, with that additional aspect of a third-party administrator in there. Trying to keep everyone on the same page is important as well. Another stressor might be the idea of potential findings or deficiencies. You know, as auditors, we're trained to audit with the participant in mind, and with employee benefit plans, it's less about materiality and more about plan document compliance. Therefore, if there are any potential findings, you know, most likely they can be mitigated and corrected within a year's time and shouldn't be recurring comments if corrective actions taken timely. And ultimately, they're intended to be brought to your attention. You know, where might the plan be at risk? And ultimately, the goal is to put the plan in a better position from a regulatory and compliance perspective. So now we will move into talking about these common deficiencies and what we oftentimes run into when auditing defined contribution plans. So we'll touch on the definition of compensation, lack of meeting minutes documented, all the way to distribution authorization issues. So with that, I believe we have our first polling question. And so the first polling question is true or false. In 2019, there were over 580,000 401k plans in the United States.
All right, that first poll is now open. There should be a box on your screen that you can actually click on to answer. All right, let's go ahead and close this poll here. And here are the results.
All right, 98% said true, and that is correct based on that study done by the Investment Company Institute. Right. First up for common errors is issues related to being able to remit employee contributions to the plan timely. There is an expectation set by the Department of Labor that indicates that employee or participant contributions should be remitted to the trust and to the plan and invested in a participant's account as soon as administratively possible. There is a misperception that there is a safe harbor provision out there. There really is not a black and white number like 5 days or 10 days or 15 days, but rather it's as soon as administratively possible, and it's important that you are consistent with that trend and how long it takes you to remit those contributions. So if a plan sponsor can prove that they can remit contributions within 1 to 2 days consistently, and then have a contribution that takes 10 days to remit, this likely should be identified as a late remittance and corrective action should be taken. But if there was a unique circumstance that led to that 10-day outlier and it's well documented to support why, you know, that pay period, 10 days may have been considered to be as soon as administratively possible, and you might not have to report it. So it really is circumstantial based on those individual pay periods. And when we come in and audit, we're looking for what is that trend? What does it typically take a plan sponsor to remit those contributions? And the key here, again, is to ensure that you have documentation if and when you have those outliers that kind of occur outside of your normal remittance pattern. So, you know, ultimately, if you have 1 or 2 that maybe slip through the cracks, you know, while on the surface, the penalties and fines themselves may seem really insignificant for filing any formal paperwork related to that, it will help support that you're committed to compliance and making appropriate corrections when they're identified. Another plan sponsor, in comparison to that 1 to 2 day trend, another plan sponsor, there's as soon as administratively possible, might be more like 7 to 10 days. So really, like I said, you know, there's not an identified X number of days. It is individual for each individual plan sponsor. But things that you can do to protect yourself against a late deposit situation is, you know, having documentation to support what is as soon as administratively possible for your plan, having a clear outline of what the process is, what the controls are. And it's also good to have a backup plan in place if at all possible. You know, if one person is typically responsible for remitting to the trustee or the TPA? Is there a backup that can be put in place if they're out sick or on PTO? And again, ultimately having that documentation of what these processes are, so that if when you have those that might fall out of your normal routine, you have documentation to support that. So like I said, there are penalties and fines that are imposed if you find yourself in this situation with late deposits. And the longer they take to deposit and the larger they are, the more costly it can become. So as long as you correct, as soon as you discover that maybe you had a couple that were considered late, the less costly it should be. The second one here is definition of compensation. And this is probably the area where we most commonly see issues or errors in our testing. The plan document itself for each plan has a defined definition of compensation, and it may or may not have specifically identified exclusions. So it's important to understand what those are, and in practice, you're properly applying that definition of compensation. As an example, we have seen numerous times where a special payroll is issued for bonus compensation and the plan sponsor does not withhold any 401k deferrals on that pay, but the plan's definition says that this is eligible compensation. So this would be considered an error if there is no other documentation noting that the participant did not want deferrals taken on that pay. And when that's applied across the entire population of participants, it might be a significant amount that the plan sponsor ultimately may be required to correct using their own dollars. Another example that we commonly see in practice is that you might be excluding certain fringe benefits from 401k deferrals, but your plan's definition doesn't specifically exclude these items. I did have a client a few years ago where we were performing the audit for the first time, but it had been audited in the past. And the client had notified us that they had discovered an error in their application of the definition of comp during a more in-depth internal audit that they had performed over payroll in that year. So the definition per their plan document indicated that all box 1 wages, meaning all taxable wages, were eligible compensation with no specific exclusions that were identified. They discovered that since 2009, they had numerous pay codes for taxable fringe benefits that had been excluded from eligible compensation for both employee and employer contributions. And so they ultimately determined that a correction was needed going back to 2009 all the way through 2017 that totaled over $100,000 plus an additional $39,000 for lost earnings. And then the plan sponsor made that correction using their own dollars to make those participants whole. And then in 2018, what they ended up doing was amending their definition of compensation to properly exclude those items going forward. So it's important that you understand your definition and that your payroll team that's processing payroll and applying these inclusions or exclusions understand it as well, to ensure that what is happening practically each pay period aligns with what is defined in the plan document. And at least annually, you should perform a review of those compensation definitions and ensure that the individuals in charge of determining compensation for individuals are properly trained and understand what that plan document says as well. On the topic of 0% election forms and employee eligibility, particularly in plans where there's an age requirement to participate in the plan or there's a service requirement period that must be met, it's important to document or have a documented process on how employees are notified of their eligibility to participate in the plan. As part of our testing, we look to see that those participants who are eligible participate in the plan but are choosing not to participate have actually declined participation. This is best supported by a signed election form stating that the participant does not want to participate. But more often than not, a plan sponsor indicates that they notified an employee of their eligibility, but the participant never returned the signed form declining participation. And in this circumstance, it is important to have that documentation to support how the employee was notified that they were eligible. You know, was it discussed with the employee during their orientation? They were given the enrollment packet at that time. Do they receive an email once they're eligible to participate in the plan? Because ultimately the risk to the plan sponsor is that the employee would come back months or years later indicating that they were not aware or made aware that they were eligible and would have participated had they known. So the plan sponsor would be at risk to make that participant whole for failing to notify the employee of their eligibility if there is no other documentation to support that they were notified. So if your plan doesn't have service or age requirements, there is much less risk related to this issue for obvious reasons. But another area is auto enrollment can help mitigate this risk as well. You know, because if someone's not participating in an auto enrollment plan, then, you know, this would mean that they had to decline participation, and there should be a paper trail or a virtual trail of this. But it's also important that you have an awareness of what that documentation is, especially if that's handled all at the third-party administrator level. You know, is there written documentation, or does the TPA have a kind of date and time stamp record to support when a participant or an employee might have declined participation? On the same topic of eligibility, some plans have different eligibility requirements for different classes of employees or for different types of contributions, whether it's employee versus employer, or sometimes plans have multiple types of employer contributions. You know, as an example, we have a plan where the plan sponsor is an insurance company. They have several different classifications of employees based on whether they're full-time office employees, a part-time adjuster, or a full-time adjuster. And each classification of employee has different eligibility requirements, both for the employee deferral eligibility and for different types of employer contributions that are offered. And so the risk here is that employees are not properly notified of their eligibility or allowed to enter the plan based on their employee classification type. And so if they change employee classification, ensuring that you're properly applying any new eligibility requirements. And if you have a plan with different requirements, again, it's important that you as a plan administrator understand this, but also important that your human resources individuals and payroll individuals understand these different requirements as well. And that you have a consistent eligibility notification process where all employees are notified in the same manner when they become eligible. So to help mitigate risks related to any issues with eligibility notification and ensuring the application of proper eligibility requirements, recommending, you know, streamlining eligibility requirements as much as possible. This might not make sense for every company or every organization based on the dynamics of the employee base, but ultimately it will make it easier on you and less potential for complications with that eligibility notification. We have seen a lot of plans moving to those auto enroll plans or moving to no age service requirements, at least for the deferral portion of participation in plans in recent years, just removing some of that kind of administrative effort related to eligibility notification. The next one here on lack of meeting minutes and fiduciary oversight. This is a big one that as plan sponsors or administrators, if you're not documenting meeting minutes to support fiduciary oversight, this should be an area where you make an immediate change. You know, if we come in and perform a financial statement audit for the plan and note that there is no documentation or no documented minutes that support that fiduciary oversight of plans are occurring, you know, we might conclude that there is a deficiency in internal control and report that to management, but we'd still be able to issue our report on the financial statements and have your report to attach to your 5500. If the IRS or the DOL in particular were to come in and perform an exam and note that, they likely would have a little bit more scrutiny over this particular area. Out on the IRS's website, there is a section with basic responsibilities listed about retirement plan fiduciary responsibilities, and documenting meeting minutes is an important item on there. It also may be important for you to consult experts in certain fields like investments or accounting, and give consideration on whether or not you would want to bring them in and be part of your committee and have that documented in your minutes as well. And why is this important? In the last 10 years or so, there have been numerous lawsuits in this space where participants alleged fiduciary misconduct, particularly related to excess fees charged within plans. And in these cases, the plaintiffs were alleging that the plan sponsors, members of their benefits committees, breached their fiduciary duties under ERISA by requiring participants to pay excessive fees, either in the form of overly high expense ratios for mutual funds or overly high fees paid for record-keeping services. Many of these cases ultimately did go in favor of the employees or the plan participants because of the lack of documentation that was retained related to investment and fee monitoring by the plan sponsor. So in many cases, there was conversation that was happening, but there was no documentation to support that it was happening. So how can you protect yourself in this area? Having a designated committee charged with oversight is important. You may want to consider whether these committee members should have committee training so they understand their responsibilities and understand the administrative fees charged directly to plan participants, and understand any revenue sharing that's incorporated into your plan administration. So this should be formally reviewed, and investments should be monitored, and fees should be monitored, and making sure, again, to document this. All right, we have another polling question. True or false again here. If an employee changes categories of employee type, you need to be aware of the impact that this might have on eligibility to participate in the plan or receive certain types of contributions.
All right, that second poll is now open.
All right, and that answer again, yes, is true. So always have it in awareness when there are any employees changing categories of different employee types, especially when you have different requirements. All right, another area where errors can occur is in the application of vesting and making sure you're properly utilizing the vesting schedule that's in the plan document and any related forfeiture activity. The vesting schedules can sometimes be confusing to understand, and some plan documents indicate that vesting period is based on a plan year. Others indicate that a year of service is a plan year in which a participant has worked 1,000 hours or more. So it's really important to understand how the vesting provision should be applied when participants terminate and fall within that vesting window. And it probably gets particularly tricky when you have those mid-year hires. So as an example, if someone was hired on August 1st, they're eligible to participate right away, and your vesting schedule indicates that 1 year of service for vesting purposes is a plan year in which the participant worked 1,000 hours. So if this person was able to work 1,000 hours from August 1st to December 31st, this would mean that they likely get 1 year of service credit for that 4-month period. And they could terminate in July of the following year, technically not having a full actual year of service, but could end up with 2 years of credited service for vesting purposes, again, depending on how that vesting schedule is written, what the definition of 1 year of service is. So it's important to ensure there's a process in place to review vesting and forfeiture calculations for individuals taking distributions that are not fully vested. A lot of times, the third-party administrator might assist with this calculation, but we have had instances where TPAs improperly calculated vesting for several years, and it did create a lot of headache down the road. In that case, it was a new vesting schedule had come out. It didn't get properly applied into the administration. And the issue becomes you might have some employees that had more forfeitures taken from their distribution than should have been, or not having enough forfeitures taken. The first probably being the bigger issue, since those dollars should have been made available to the participant, and can lead to a little bit of a lengthy correction process. In instances where you have any mergers or acquisitions and merging plans, have differing vesting schedules, it's important to ensure that, grandfathered years of services are credited appropriately to employees, and that the new single vesting schedule is properly utilized as well. On the topic of loans, many plans offer a loan option to participants. Not all plans, but a lot of plans do. And this is when a participant is able to take money out of their participant account with the intention to pay the dollars back into the plan over a 5-year period or less, unless the dollars are utilized for a home mortgage, in which case the loan period can be extended. But most loan policies, really mirror language that's put out by the IRS. But we have seen compliance errors where plan sponsors are not properly following the terms of their own individual loan policies. For example, every policy has a little different language in regards to what loan interest percentage they'll apply to any given loan during the year. Prime plus 1 is a pretty common benchmark utilized, but sometimes they're different, and that's something during our audit that we're looking to ensure that they utilize the correct loan interest percentage based on their policy. So again, it's ensuring that what you're doing in practice complies with what is stated in the policy. Loan policies also should indicate that a participant cannot take a loan out for more than $50,000 or more than 50% of their vested balance, whichever is lower. So it's important to monitor the loan amount requested versus the vested balance in the participant's account to ensure you don't allow loans outside of that limit. And loan policies also always have a limit on the number of loans that an individual person can take at one time. Most only allow 1, but some plans do allow up to 2 or 3 to be taken at any given time. And if you have a plan that does allow multiple loans to be drawn at once, this is something to closely monitor so that you don't violate that loan policy. Having a formal loan policy and automating that process will really help mitigate these risks, but also making sure that you have, documentation in place to address any market changes that might occur from the time of the loan being signed versus when the dollars are issued to the participant. Because if there is a market decline, that might impact that assessment of where they were at from their vested balance versus what was issued as a loan. And it's good to know that in the current environment here in 2020, there was some relief provisions with the CARES Act related to loans, kind of expanding what those policy requirements are. But a plan would have to formally adopt those provisions for them to apply to their plan. Another area that we can sometimes see errors or issues is related to plan compliance testing. So there are different types of compliance tests that apply for different types of plans, and some incorporate complex calculations based on data that's specific to your plan. So it's important to know which tests are actually applicable, and it's important to have the compliance testing performed annually and on a timely basis so that you can know, sooner rather than later if you have any non-compliance issues that need to be corrected. And once you get those results, you'll want to make sure you understand the failures, understand the necessary corrections involved. I've reviewed and read many compliance testing results documents, and they're not always straightforward and easy to understand what corrective action is needed, if any. Sometimes there actually isn't any sort of correction that's needed based on circumstances within the plan. This ADP and ACP testing has been a focus of the IRS in recent years, failing to provide timely written notice to participants or failing to provide proper safe harbor contributions to participants if your plan is a safe harbor plan. So this also has been an area of IRS focus during their exams as well. Moving to the area of distribution, so these would be dollars leaving the plans, obviously, and specifically hardship distributions. The IRS and DOL in particular have a heightened focus on hardship distribution activity because this means that dollars are leaving the plans for active participants and not returning, unlike a loan taken from a plan by an active participant, which ultimately is making its way back into the plan. Issues that have been identified are plans allowing participants to take hardship distributions when the plan document didn't actually allow it. it's important to know that from the IRS's perspective, it's insufficient for plan participants to keep their own records of hardship distributions, and there is a responsibility placed on the plan sponsor to obtain supporting documentation. So if documentation regarding reason for hardship is obtained and retained by the third-party administrator, do you as a plan sponsor have an understanding of what that process is and what is retained for support of the hardship distribution? In order to allow participants to have easier access to the cash balances in their 401k and 403b accounts when a hardship occurs, recent guidance from the IRS allows a plan administrator to rely on a participant's written self-certification that the participant has insufficient cash or liquidity to satisfy financial need. And so unless the plan administrator has any actual knowledge to the contrary, they can go ahead and issue those hardship distributions based on those self-certifications. And if a plan permits the self-certification, the plan sponsor still has a responsibility to notify the participant of a few things. The first being that the hardship distribution is taxable, that the amount of the distribution cannot exceed the immediate and heavy financial need, and the recipient has to agree to preserve those source documents and to make them available at any time upon request to the employer or the administrator. The last item there generally causes plan sponsors and benefit plan auditors concern because it does not seem to indicate that the plan sponsor would be required to provide the source documentation upon request of an independent auditor or an IRS agent. And so in the event that you're under an exam, how are you going to get access to that information to support that? Do you feel that that coverage on the self-certification of telling the participant that they have to preserve those source documents are going to mean that those source documents are going to be readily available upon audit? So I have read in a few places that as a best practice, a plan sponsor should consider still requiring a participant to scan the source documents to the plan sponsor or the TPA at the time of the self-certification. This will mitigate that need to obtain documentation from a participant potentially years after the hardship distribution occurs. So really just navigate wisely if you're allowing self-certification for hardship distributions and making sure you have a process in place that if you need to access that source documentation, you'll be able to do so. And also on the topic of distributions, one of the distribution authorization is probably one of the other areas where we can sometimes see issues. And this really is one of the larger risks related to employee benefit plans. You have dollars that are leaving the plan, and if not being rolled over into another plan, they're no longer being utilized for retirement savings purposes. So there needs to be a process in place to ensure that there's proper authorization that has occurred by the plan participant. So this includes ensuring that the type of distribution the participant wanted to receive is actually what was received, that any additional tax withholding was applied, and ultimately that the participant was actually eligible to take the distribution. Certain plans also require spousal consent, and it's not always something that's straightforward when you're reading a plan document, so it's important to understand that if this is required in your plan, that you're obtaining that spousal consent for married participants. I would say this is most commonly seen in plans that have an annuity option for distributions. And in today's electronic world, more and more plans and third-party administrators are moving to electronic authorization and approval. So if that's the case for your plan, again, it's making sure you understand what that process is and what a participant must do to properly authorize a distribution from their participant account. What documentation is the TPA retaining to support that authorization? I know as auditors, this is an area that we often face as kind of a challenge in our audits as things become more and more electronic and gaining comfort with that participant authorization record. So sometimes we opt to confirm directly with participants, depending on the level of information that can be provided. So kind of in conclusion, that kind of wraps us through those 10 common errors. And if you haven't made note of it by now, the number one thing that you can do to ensure you minimize your plan's risk for many of these errors or issues is to really know your plan. Understand your plan document and your adoption agreement if you have one. You should Perform a review at least annually of your plan document to ensure that you're following all plan provisions, and ensure that you have processes and controls in place to ensure accountability can be upheld, particularly in those areas of timely remittance of contributions, educating employees and participants on the plan, and notification of employee eligibility if you have requirements. And also, when you're hiring service providers for the plan, whether it's your TPA, your investment advisor, or external auditor, make sure you do your research and, is the service provider one that you find knowledgeable and will provide quality services. Kind of on that same line of what you can do is reviewing information by the plan sponsor must still occur, even if you have a TPA that's assisting with much of the plan administration. So you have to ensure that your census records are cross-checked with the third-party administrator records periodically, that you have proper controls in place to ensure accurate payroll information is kept for participants. Payroll really drives the deferrals and any related employer contributions. Therefore, if the payroll is incorrect, by default, the deferrals are incorrect. So if participants are making electronic deferral election changes with the TPA, there needs to be a process and a control in place to ensure that the deferral percentage change accurately is adjusted within the payroll records. Also, understanding your plan's definition of compensation and any specific exclusions from compensation is important, and understanding that process for reviewing and authorizing distributions from the plan. As I've mentioned throughout many of these areas, automation is something that can really help reduce errors in your plan. But it's also important to recognize that even though a third-party administrator may handle the majority of this with that automation, the plan sponsor still has a responsibility to understand the process and perform periodic reviews on their own as well. Even in the world of automation and electronic or virtual plan records, it's important to understand that audit trails and documentation are still key. So checking with the TPA periodically for records that they have and retain. I oftentimes see emails that are retained to help support certain electronic approvals or change records, maintaining supporting records for those 0% elections or when participants are declining participation if at all possible, and having support for those deferral election changes. And last but not least, that meeting minutes topic, ensuring that you have documented meeting minutes in place to support that you're monitoring the plan and executing on those fiduciary duties. Kind of circling back to DOL and IRS, kind of in conclusion, much of what we talked through today, common errors that we see through our experience with financial statement audits of employee benefit plans. You might find yourself in a DOL or IRS exam. And as I mentioned, much of their exams are data driven, so their limited resource leads them to using that data mining of 5500s often for determining who's going to be flagged for an audit. But filing timely 5500s by the first or extended deadline, is one big way to avoid being flagged by the DOL or IRS for any sort of audit and avoiding any sort of penalties or fines. But if you do find yourself in a scenario where an error has occurred, whether you discover it on your own or it's discovered through an exam, it's good to know that it's okay. There are correction processes and programs in place, but the key is really to ensure that you respond timely and make proper steps towards correction. So if you do find yourself in an audit situation with the DOL or IRS, biggest recommendation is going to be to provide them with all the documents that they request and provide them as timely as possible. These requests can oftentimes be very lengthy and requesting data going back for several years. I had a client recently who was flagged for an IRS desk audit, and they sent me the request list, and it was about 12 pages long. And they asked for payroll and plan document information going back for several years. So, it's definitely a detailed look at information, and I would encourage you to reach out to your third-party administrator or possibly your auditor to assist in pulling together any information that they're requesting, or just to help provide guidance on any questions that you might have during that process. As far as kind of what's on their radar, you can go online to both the IRS and the DOL websites and read their work plans for the upcoming years. So this tells you what their focus has been on and where their attention is directed when it comes to audits. You know, I mentioned that these exams are based on data mining of 5500s, but they also commonly act on referrals or claims or complaints. So specific areas of focus for the IRS include ESOPs, 403B and 457 plans, and terminated cash balance plans. With the ESOPs, they're looking to determine whether the employee stock has been properly valued, the annual allocation of employee stock meets the non-discrimination requirements, and that employer loans follow conditions and terms of the plan document. You know, with the 403B, 457 plans, and terminated cash balance plans, they're looking to ensure that the Internal Revenue Code provisions specific to those types of plans are adhered to, you know, such as universal availability in 403B plans, and in 457 plans, they might be looking for excess contributions and the proper use of, you know, that special 3-year catch-up contribution rule. As for the DOL, their focus continues to be in that area of fiduciary malfeasance and plan oversight, but much of their programming is around educating plan sponsors and providing resources to help them avoid being in any sort of fiduciary malfeasance situation. So there are a lot of good resources that the Department of Labor has available to plan sponsors to help in this area as well. So here we have our fourth polling question, and it is, what is the extended 5500 filing deadline for 2020? All right, so October 15th is the correct answer. So there has not been any sort of extension or change for employee benefit plan filing deadlines. I know there's been extensions for the regular 12/31/2019 tax filing deadline out to July 15th. But currently for the 5500 filing, that first deadline still remains as July 31st with an extension out to October 15th. And last but not least, just wanted to provide this group with some other helpful tools. If you have other questions or looking for some other resources, out on the AICPA's website, there is an interest area for employee benefit plan audits and audit quality. So just has some plan advisory communication information and tools for plan sponsors. Also out on the IRS's website, they have a specific section for retirement plans and actually a specific section for correcting plan errors. And so in that area of the website, they have multiple fix-it guides. And so they have different guides for different types of plans. So as an example, there's one for 401k plans, one for 403b plans, and has a lot of information, some, you know, similar to what I've shared with you today, but, you know, what are common errors, what are ways you can correct it, and what are ways you can prevent it. There also is information on the IRS's website if you do find yourself in a correction situation and you want to follow through with maybe one of the correction programs available. A lot of information out on the IRS's website on how to follow through with that. So with that, that really concludes our discussion today on talking through benefit plan errors. I have left my contact information here. If there are any questions that anyone has, feel free to shoot me an email after the session and I'll be sure to get back to you. So thank you.
Awesome. Well, thank you all so much for attending, and thank you to Maria for hosting, and we hope everyone has a great day. Thank you guys.